Hey there, future Wall Street wizards. So, you're ready to take on the exciting world of stock investing? That's fantastic. It's like a thrilling roller coaster ride with its ups and downs, twists and turns. But before you buckle up, let's talk about something super important, understanding the risks. Think of it like this. You wouldn't jump out of a plane without a parachute, right? Investing without understanding risk is kind of like that. You need to know what you're getting yourself into. But don't worry, I'm here to guide you. Investing in stocks means buying a piece of a company. You're betting on that company's success. Sometimes your bets pay off big time and you make a tidy profit. Other times the market throws you a curveball and you might lose some money. The key is to be prepared, not scared. By understanding the different types of risks involved, you can make smarter decisions and protect your hard-earned cash. So let's dive in, shall we? First up, let's talk about market risk. This is the big picture stuff, the overall ups and downs of the entire stock market. Think of it like the tide. Sometimes it's high, sometimes it's low. You can't control the tide, but you can learn to surf. Remember the 2008 financial crisis? That's a prime example of market risk in action. The entire market tanked, and even the best companies saw their stock prices plummet. Or how about the dot-com bubble burst in the early 2000s? Boom! Just like that. Tons of tech stocks lost their value overnight. But hey, don't let this scare you off. Market risk is just part of the game. The key is to stay calm, ride out the waves, and remember that the market tends to go up over the long term. Now, let's zoom in a little and talk about company-specific risk. This type of risk focuses on individual companies and the unpredictable stuff that can happen to them. Think product recalls, management shakeups, or even a scandal involving the CEO. Remember when Samsung had to recall its Galaxy Note 7 phones because they were catching fire? Yikes. That's a classic example of company-specific risk. Samsung's stock took a hit, and investors who had bet big on the Note 7 felt the burn. Or how about when a company's star CEO suddenly resigns? That can send shockwaves through the market and affect the company's stock price. The key takeaway here is that even if a company seems rock solid, unforeseen events can always pop up and throw a wrench in the works. That's why it's crucial to diversify your investments. But we'll get to that in a bit. All right, remember that old saying, don't put all your eggs in one basket? Well, that applies to investing too. Diversification is key when it comes to managing risk. Think of it like this. If you invest all your money in one company and something bad happens, you could lose everything. But if you spread your investments across different companies, industries, and even asset classes, you're less exposed to any one particular risk. It's like having a safety net for your investments. If one stock takes a tumble, the others can help cushion the blow. So don't put all your faith in one single stock, no matter how promising it seems. Remember, diversification is your best friend. Section 5. Knowledge is power. Research before you leap. Now, before you go throwing your money at every stock that catches your eye, let's talk about the importance of research and due diligence. Remember, knowledge is power. Before you invest in any company, take the time to learn about their business, their financials, their management team, and their competitors. What products or services do they offer? Are they profitable? Do they have a solid track record? Don't just rely on rumors or hot tips from your Uncle Bob. Look at their financial statements, read industry reports, and follow their news and announcements. Trust me, a little research can go a long way in protecting your investments. Section 6. Safety nets for your investments. Introducing stop-loss orders. Here's a handy tool to have in your investing arsenal. Stop-loss orders. These are like safety nets for your investments, helping you limit potential losses. Here's how they work. You set a specific price at which you're willing to sell a particular stock. If the stock price falls to that level, your order automatically triggers and the stock is sold. This helps prevent further losses if the stock continues to decline. Think of it like an insurance policy for your investments. It's not foolproof, but it can help you sleep better at night knowing that you have a plan in place to mitigate potential losses. Section 7. Mastering the stock market. A journey of learning and growth. Well, folks, there you have it. We've covered the basics of stock market risks, from market fluctuations to company-specific events. Remember, investing in the stock market is a marathon, not a sprint. There will be ups and downs along the way, but by understanding the risks, diversifying your portfolio, doing your research, and using tools like stop-loss orders, you'll be well on your way to mastering the market. Keep learning, stay informed, and never be afraid to ask for help when you need it. And most importantly, remember to have fun. After all, investing should be exciting, not terrifying. Section 8. Keep your eyes on the prize. Stay informed, stay invested. As we wrap up this whirlwind tour of stock market risks, remember this: the key to success is staying informed. Keep learning, keep asking questions, and never stop educating yourself about the markets. The world of finance is constantly evolving, so it's crucial to stay up to date on the latest trends, news, and analysis. Read books, follow financial websites, listen to podcasts, whatever it takes to stay in the know. Remember, knowledge is power, especially when it comes to investing. The more you know, the better equipped you'll be to navigate the markets and make sound investment decisions. Now go out there, make smart choices, and watch your money grow.